All right, let's get right into it. In this explainer, we are unpacking the hidden mechanics that somehow connect a trillionaire's massive paper loss, a fast food sandwich empire, and your very own household budget. Today, we are laser-focused on one overarching framework that ties all of these wild financial stories together, and that is the 7 rules of wealth. If you've ever wondered how the money behind the money actually operates behind closed doors, well, you are in the exact right place.
So here is our roadmap for the explainer today. 1. The Wealth Playbook Revealed. 2. The Trillionaire's Paper Loss. 3. Ownership versus Employment. 4. Your Real Financial Audit. And 5. 10 Legal Wealth Moves.
Starting right off with Section 1, the Wealth Playbook Revealed. Think of these 7 rules of wealth as the invisible architecture of big money. This is going to be our thematic anchor for today, so definitely keep this list in the back of your mind as we go through some real-world case studies to prove exactly how these rules dictate who wins and who loses. We're talking everything from Rule 1, earning without showing off, all the way down to Rule 7, keeping what you build. Because as the old saying goes, making the money is one skill, but actually keeping it, that's a completely different game entirely.
Moving right along to Section 2, the trillionaire's paper loss. Let's really look at Rule 7 in action. $750 billion. I just need you to pause and let that number sink in for a second, because it is absolutely absurd. That is exactly how much Elon Musk lost, on paper, in just 6 weeks. When SpaceX went public back on June 12th, the stock just skyrocketed, right? Musk literally became the first trillionaire in human history, sitting on roughly $1.45 trillion. But fast forward to August 1st, that number dropped down to about $690 billion. He lost $750 billion. That is an entire country's GDP just evaporating between 2 Tuesdays. But you have to remember, most of that money was never sitting in a checking account. It was all stock. And his whole situation is basically a masterclass in concentration risk. It proves that even a literal trillionaire's portfolio would probably sleep a little better at night with some diversification, instead of relying solely on one incredibly volatile stock. When you concentrate your wealth that heavily, the swings are going to be violent in both directions. Now sure, it's mostly theoretical until you actually cash a check, but it is a massive, real-world lesson for the rest of us on why spreading out your investments is absolutely crucial.
Next up, Section 3, Ownership versus Employment.
Now this stark contrast really drives home Rule 2, own the game. Peter Cancro started running his first Jersey Mike's when he was just 17 years old. After a 50-year hustle, the private equity giant Blackstone swooped in and bought 80% of the company for $8 billion, taking the company public at roughly $7 billion. Here's where it gets interesting. Blackstone set up these massive bonuses for 293 corporate headquarters employees. We're talking up to 200% of their salary in cash or stock. But the franchise workers actually out there slicing the salami and making the sandwiches every day, they got 0 from the IPO. The reality is, the people who structure the deal get to decide who gets paid when the company goes public. Blackstone didn't get rich working at Jersey Mike's, right? They got rich owning it.
Okay, shifting gears to Section 4, your Real Financial Audit. Think of this section a bit like your grandma at Thanksgiving giving you the tough love you actually need to apply Rule 5, Assets First.
Now, before you see this 21% jump in property foreclosures and start panicking about a 2008 repeat, let's take a breath. Yes, we saw more than 227,000 U.S. properties file for some stage of foreclosure in the first half of this year. But the boring, non-clickbait truth here is that we are nowhere near crash-level numbers. What we're actually seeing is just the quiet, everyday reality of higher property taxes, pricier home insurance, and generally stretched household budgets. If you're a homeowner, consider this your wake-up call to audit your real housing costs before they sneak up on you.
So take a look at these income tiers and find your rung on the ladder. And hey, don't get your feelings hurt here. This is strictly a baseline reality check. You have to know your actual numbers. Whether you're in the lower middle class range of around $55,000 to $83,000, or you're sitting in upper income above $167,000, knowing exactly where you stand financially is step 1 to actually applying those 7 rules of wealth. Because once you know your numbers, you have to build a structure to protect them. And accountability works at every single level. Just look at these 2 completely different examples. First, New York City put a real collections effort together and recovered over $9 million in unpaid pollution fines from Amazon. That is a $2 trillion giant having to learn that idling delivery trucks isn't just a victimless crime they can ignore. On the flip side, look at the financial education platform Melanin Money.
They used structure and consistency from the ground up to help regular people build a collective $1.1 billion in community net worth, and now they're launching a $100 million initiative for HBCU students. The takeaway? Accountability and structure work, period.
Which brings us to Section 5, 10 Legal Wealth Moves. Time for a quick tactical sprint. Let's look at 10 completely legal IRS tax strategies you can use to apply Rule 4 and actually make your money work for you. These first 5 structural moves are absolute game changers. For example, using an S-corp allows you to legally split your earnings into a salary and business distributions. That lets you dodge self-employment tax on a chunk of your money, potentially saving you roughly $8,000 a year on $100,000 of income. Or look at number 2. You can legitimately hire your own kids to do real work for your business, and their first $14,600 is taxed at literally 0%. You're keeping that money in the family instead of just handing it over to the IRS. You can also show a paper loss on a rental property through depreciation, even while the actual value of that property keeps climbing.
Let's zoom in on that first one, the Augusta rule, because it's fascinating. You are basically getting paid, totally legally, by the IRS to host a business meeting in your pajama pants at your own kitchen table. Your business deducts the expense, and you, the homeowner, receive that payment entirely tax-free. It's a brilliant move.
Looking at the back half of the list, these 5 strategies really highlight how the tax code heavily favors ownership. You can use Section 179 to write off massive business vehicles, which, by the way, is exactly why those heavy luxury SUVs are so incredibly popular with business owners. Or, if you're patient with your investments, married couples earning under roughly $94,000 might pay literally 0% in long-term capital gains tax. From backdoor Roths to qualified business income deductions, the entire system is designed to reward people who own.
And I have to highlight the HSA here, the Health Savings Account, because it perfectly illustrates how powerful these tools are. It is the only account on this entire list that pulls off this incredible triple play, keeping your money completely shielded from taxes for decades. The money goes in untaxed, it grows untaxed, and it comes out untaxed as long as it's for qualified medical expenses. It's almost too good to be true, but it's right there in the tax code.
So look, we've covered a lot of ground today. Trillion-dollar paper losses, private equity sandwich empires, and some seriously powerful tax structures. But let's be real for a second. Information without action is just entertainment. And we didn't go through all these rules just to have a fun time. So don't ask what your next move is. Instead, ask yourself, which of these 7 rules of wealth represents your ultimate growth edge right now? Which rule is completely missing from your financial playbook? Find it, apply it, and start building your wealth the right way.